Hello, and welcome to our 2019 Annual State of the Markets presentation. This is Chad Staskell. I'm the president of Eagle Wealth Management, and I'm happy to have you joining in and look forward to sharing some important information with you. First off, so I can keep the regulators and attorneys happy, I'd like to draw your attention to these disclosures. Most importantly, this presentation is chock full of opinions, estimates, forecasts, and statements of financial market trends, and they're all subject to and will change without notice. While we believe this information contained in this commentary is reliable, this presentation is not a recommendation, and you should talk with your financial advisor for further information if you have any questions. Let's get started. As you know by now, the financial world is incredibly complex, and these days, we're bombarded with dramatic headlines and contradicting opinions. Today, we want to give you a clue in on some of the data that we are watching. Of course, we can't cover everything, but we're going to try to touch on the most relevant factors that pertain to the U.S. stock market. And while past performance does not guarantee future results, we will focus on trends that may give you a clearer picture of where we are and where we're heading. Here's what we're going to talk about today. How did stocks perform in 2018? What drove market performance in 2018? Where are we now? And what most of you probably want to hear, what do financial experts forecast for 2019? Let's start off by putting last year's market performance into perspective. At the end of 2017, well-known analysts gave their predictions for the S&P 500's performance in 2018. All but one predicted the index would grow, and as you can see, growth failed to meet the average projections. Although the S&P 500 rose over the first 3 quarters, it lost nearly 14% in the fourth quarter and ended the year down 6.2%. This decline marked the index's worst yearly return since 2008. The S&P 500 wasn't the only domestic index that struggled last year. The Dow lost 5.6% and the Nasdaq dropped 3.9%. I know, these returns and last year's volatility may feel unsettling. As is often the case, the fundamentals can tell a very different story than what the first appearance may look like on the surface. Our goal today is to help you see what we saw in 2018 and what 2019 may hold. So, why did volatility return to the market last year? And why did stocks struggle so much in the fourth quarter? While a number of factors influenced 2018's performance, the following 4 details stood out: trade tension, interest rate increases, midterm elections, and a yield curve inversion. So volatility returned to the markets in 2018 after a very calm 2017. Despite the S&P 500, Dow, and Nasdaq reaching new highs during the year, all major indices finished the year on a down note. So what factors contributed to last year's turbulence? We broke down 2018's major economic events into 4 categories for a clear picture of how the markets performed. International trade disputes dominated the headlines in 2018. Notated with the darker green point are the key dates from these conflicts. Throughout the year, talks and tariffs dominated the headlines. And also interest rates. With growing economy and robust job market, the Federal Reserve raised interest rates 4 times in 2018. You can see March, June, September, and December, the Fed incrementally raised interest rates a quarter point from 1.5 to 2.25 to 2.5. The fears that monetary policy was tightening too quickly, which is bad for equity markets, sent markets falling sharply in October and also in December. Then there's the midterm elections. The U.S. midterm elections resulted in a Democratic control of the U.S. House of Representatives, creating a split control between the Senate and Congress. Here's how markets acted before and after November 6. There was October sell-off where the S&P 500 experienced its largest monthly losses in more than 7 years. Then November 6th, the U.S. midterm elections results tipped the power of Congress, limiting the chances for major economic legislation in the coming years. the S&P 500 reacted by jumping 2.1%, the largest increase following midterm elections since 1982. Then there's the yield curve inversion. This happens when short-term bonds move above long-term yields. Analysts call it an inverted yield curve. Though some analysts worry this may signal an economic downturn, the negative dip is likely a result of the Fed tightening its balance sheet. On December 3rd, the 5-year Treasury yield falls below the 3-year yield, the first yield curve inversion in over a decade. The same day, the S&P 500 dropped by 3.2%. With these major economic events in mind, let's turn to the details. First, trade tensions. International trade dominated the headlines, and investors' attention this year as President Trump followed through on his commitment to cut U.S. trade deficits. In 2018, the U.S. imposed tariffs on billions of dollars of imports from around the world, including China, European Union, Canada, and Mexico. In particular, the U.S. implemented 25% tariff on steel and a 10% tariff on aluminum imports in order to strengthen U.S. manufacturing, but that caused Canada, Mexico, and the European Union to respond with their own tariffs on U.S. goods. President Trump also claimed China's unfair trade practices led to imposing tariffs on $250 billion worth of trade goods. This back and forth between the U.S. and China progressed at December's G20 summit, when the two countries agreed to finally suspend additional hikes and work to reach a trade agreement. Despite the headlines, trade talks between the U.S. and other countries have generated some positive results. By the end of 2018, China agreed to reduce tariffs on U.S. goods and continue talks toward a resolution. On the home front, U.S. manufacturing has added some jobs since announcing the tariffs on aluminum and steel. U.S. trade relations with Canada and Mexico also have improved as the leaders from all three countries signed a new trade agreement, the U.S.-Mexico-Canada Agreement. The agreement opened Canada's dairy market to U.S. farmers and settled issues surrounding auto tariffs. Interest rates also dominated the headlines through much of 2018. The Federal Reserve raised interest rates 4 times in 2018. These hikes are a direct response to the 2008 financial crisis, when the Fed lowered interest rates to 0 in an attempt to stimulate the economy. Since 2015, the Fed has raised rates 9 times. According to Fed Chairman Jerome Powell, interest rate policy no longer is needed to support an already growing economy. Throughout 2018, the Fed cited continued economic growth when raising interest rates. Despite concerns from investors on international trade, market performance, and a possible slower economic growth rate in 2019, the Fed stuck to its plan. Still, news that the Fed revised the number of projected hikes from 3 to 2 in 2019 suggests it will continue moving forward with some caution to not slow the economy too much. Not all bear markets have behaved the same over the years. As you can see here, there have been 11 bear markets since 1947. A bear market is defined as a 20% drop from the market high to its current low. In this illustration, we are using the Standard & Poor's 500 index to represent the market. As you take a closer look at the chart, you can see that many of these bear markets were closely correlated to a recession. Many of you may have heard that a recession is defined as 2 consecutive quarters of negative gross domestic product growth. In general terms, that's correct. But the designation of a U.S. recession is determined by a committee of experts using past data such as government, personal income, industrial production, as well as quarterly GDP growth. So while negative GDP growth and recessions closely track each other, they are not completely correlated. As we mentioned a few minutes ago, in December, the Treasury yield curves inverted. We haven't experienced a negative spread since 2007 July. First off, why do investors care about yield curves? Essentially, when a long-term investment has a lower rate than a short-term one, a recession may be ahead. However, not all yield curve inversions are created equal. In early December, spreads between the 2 and 5-year Treasury yields and the 3 and 5-year yields were negative. By month's end, you could actually earn more interest on a 6-month Treasury bond than a 5-year Treasury bond. So, is a recession ahead then? Well, let's analyze the spreads between the 2 and 10-year yields, which is a much clearer recession predictor. These Treasury yields did not invert, and as you can see in the chart, even when these yields do invert, that doesn't mean a recession is imminent. Since 1978, after 2 and 10-year yields inverted, the S&P 500 grew for an average of 19 months and earned an average of 22% before any recessions began. So, we've looked at some of the other factors affecting market performance in 2018. Now, let's examine the headwinds and tailwinds that could affect the speed and trajectory of economic growth for the So if a recession often triggers bear markets, do we have to worry? Let's look at a group of indicators that can help ground predictions in data. This slide takes us back to late 2008. Here, we see a group of 20 indicators. These indicators help forecast pressures on the economy and financial markets in the next 3 to 6 months. Green is a positive for the economy. We would call this a tailwind, pushing economic growth along. Yellow is caution. And red, well, that's a headwind. It's going to act as a brake on economic growth. Let's look at where we were in December 2008. Here, we see a lot of red on the board. The economy is in serious trouble. The housing market is deep in the red. Volatility is high. The global economic outlook is negative, and business spending is dropping. Now, let's look at where we are in January 2018. You see a lot more green on the board. The U.S. economic outlook is strong, consumer sentiment is high, corporate profits are growing, and we see more positive signs. Overall, 17 of the 20 leading financial indicators reported positive and/or strengthening numbers. There's only one red area on the screen, and that's geopolitical risk. Here we are in December 2018. The majority of the speedometers are still green, showing positive news for the economy. The only negative on the board comes from geopolitical risk, and that is no surprise. Ongoing trade tension, as well as concerns about Europe's political and financial health, create the potential for market disruption. The yellow gauges are areas where analysts have some concerns. We will continue to watch for developments, especially over the next 3 to 6 months. Though there's clearly room for improvement in 2019, our economy reflects strength and potential, especially when it compares to 2008. Now, the past can't predict the future, and financial markets don't always act in concert with the economy. However, barring some unexpected shocks, we have a fair level of confidence the U.S. economy has continued room for growth in 2019. Let's dive a little deeper into one of those speedometers, the Leading Economic Index, LEI. This measurement includes 10 components ranging from stock prices to manufacturing orders. Examined together, the data may give a clearer, less volatile view of where we are. The latest report showed a continuing, yet slower pace of improvement. The index also indicated that economic growth should continue through 2019. As you can see in this chart, recessions have never started when the LEI is increasing. So we know the LEI is increasing and many speedometers are green, but we still have headwinds to consider. When looking at financial markets in 2019 and beyond, the following details could negatively affect economic growth and stock performance. Brexit, consumer sentiment, geopolitical risk, growth slowing in Europe, housing, monetary policy, wage increases. Any and/or all of these could create caution for the U.S. economic growth. We also believe there's a number of tailwinds that could continue to support economic growth. While the pace may be moderate and we may be late in the business cycle, positive signs still persist. You might notice that two items appear on both the headwinds and tailwinds list. monetary policy, and housing. You're probably going to ask why. Well, monetary policy is in the middle ground. Right now, we are still in a very accommodative position. With the Fed is striving to support GDP growth and interest rates remaining relatively low, the Fed is also cautiously working to get back to more normal policy. A misstep in this course could serve as a headwind to the market. For housing, rates are still relatively low. The labor market's strong and homes are affordable. Details all that signal tailwinds and growth, but increasing interest rates and a change in the deduction caps could slow gains and provide headwinds in the long term. One question we get after longer market rallies like we're having right now. Currently, we've been going since 2009 with growth in the US stock market, is how do current equity values compare to historical averages? Let's examine this chart to see whether stocks are at a fair value. First of all, PE ratio means the difference between a company's price per share, or what you pay for the stock, and its earnings per share, the E. The higher the PE ratio, the greater the difference between what investors pay for the stock and what the company actually earns. So a high PE ratio means stocks are relatively expensive compared to what they earn per share. If you look at the middle dotted line in the chart, you'll see the average PE ratio is 16.1. In other words, over the last 25 years, stocks have averaged a per price share of 16.1 times their earnings per share. In the Great Recession, the PE ratio was far below this average line. In the dot-com boom, it was much higher than average. So for much of 2018, stocks were above average values, but by December 31st, 2018, PE had dropped to 14.4 times, below the 25-year average. This data tells us that stocks are currently at below average stock prices based on their earnings as we close out 2018. This below average stock price was realized in large part due to the 14% decline in the stock prices in the fourth quarter of 2018, as well as historically above average earnings growth that was helped by the large corporate tax cuts that started in 2018, which helped boost company profits. Okay, we've discussed 2018 performance and what economic factors may come into play in the years ahead. Now, let's get down to the details I'm sure you're all interested in hearing. Predictions for markets and economies in 2019. Inflation is an important economic indicator. Rising prices impact the entire economy. Too much inflation can hinder growth, while too little can stifle expansion. In November, the Consumer Price Index for Urban Consumers, or CPI-U, which excludes rural populations, increased by 2.2% from the 1 year before. This is a little above the Fed's target rate of 2%. The less volatile core CPI, which excludes food and energy, also increased by 2.2% in the same time period. So what will happen in 2019? Although wages are increasing, analysts predict inflation will stay at similar levels this year. If this trend continues, it should support the Fed's decision to continue slowly raising interest rates in 2019. On December 19th, the Federal Reserve raised interest rates for the fourth time in 2018. Currently, their target interest rate is between 2.25 and 2.5%. In an announcement, the Fed reduced its predictions for rate hikes in 2019 from 3 times to 2 times. The market expected the December rate increase, but many investors were hoping the central bank would provide an even more dovish view on the future, or less inclined to raise rates. However, worries about financial conditions and the pace of the hikes led stocks to decline after the Fed's announcement. Ultimately, it's important to remember rising interest rates are a sign of an economy that is doing well. But what happens when interest rates rise? Let's check this chart. The orange dotted line represents 5% yield on a 10-year Treasury note. Currently, the interest rate on a 10-year Treasury note is less than 3%. Now look at where the green diamonds are. They're mostly clustered in the upper left and bottom middle. This arrangement shows us that when rates are below 5%, as they are now, equities tend to grow with rate increases. But when rates are at 5% or higher, equities tend to decrease when the Fed raises interest rates. In other words, history shows us that we may still be able to expect markets to rise as rates increase as long as they stay below 5%. With all the volatility we experienced in 2018, many investors began to worry that a recession could be around the corner. Technically speaking, 2 consecutive quarters of negative gross domestic product growth indicate a recession is occurring. If you look at this chart, you can see GDP growth picked up last year. The late 2018 and 2019 numbers are projections, but they are also indicating positive growth for the economy. While the current estimates for 2019 are lower than 2018, they are still higher than the economic growth we experienced in both 2016 and 2017. As of December 2018, the unemployment rate was 3.9%. This rate was just slightly higher than the levels we experienced earlier in 2018, but it still falls well below historical averages. With unemployment this low, wages typically rise in response. In this chart, the dark line is unemployment and the green line is wage growth. The two measures are usually inversely related. So when unemployment goes down, people can generally expect to earn more. As you see in the chart, wage growth is beginning to increase and move closer to its 50-year average. While low unemployment and increased wage growth can be positive signs, they can also bring risks. If you look at the red vertical bars on the chart, you're going to see where we have experienced recessions. In the past, when an unemployment has reached a low, a business recession was usually only a few months away. But this indicator can be easier to see in hindsight because unemployment levels can fluctuate during economic expansion. We aren't saying that a recession is imminent, but we do want to share a balanced view of what very low unemployment can mean for the economy. So, given all the predictors and what the so-called experts forecast, what do the experts forecast for domestic equities in 2019? Each year, various media outlets compile the S&P 500 price targets on Wall Street's top analysts. Let's take a look at what they have to say about the S&P 500 this year. Now, I'm going to point out these targets are not ours. They are I'm going to put in quotation mark, experts are predicting. As you can see, their 2019 estimates cover a 670-point range, or about a 20% difference from 2580 to 3250. So proof that even experts have very differing opinions. But while they gave a range of results, one trend was consistent. All the strategists are predicting the S&P 500 will continue to rise in 2019. Of the strategists we've included here, their average estimates of 2940 to 2948 would be an over 17% growth from where we ended 2018. These are unquestionably strong returns. Earlier we looked at a graph of returns during each year in the election cycle. Interestingly, 2019's average projected growth is almost exactly the same as the 17.4% average growth seen in post-midterm years since 1950. Of course, as we stated earlier in this presentation, we are not trying to foretell the future. No one knows for sure what equities are going to do in 2019, and predictions from this stage are pretty foggy. However, these analyst perspectives show that for the most part, optimism still exists on Wall Street. We've gone over a lot today. But if we take away one detail from our presentation, I hope you remember this. Emotions have no place in investing. As volatility returned in 2018, some investors grew accustomed to watching the market reacted with concern and fear. The truth, however, is that volatility is common, and 2018's numbers demonstrate a return to normalcy within the markets. Let's reference this chart of stock performance since 1980. The average year has 13.9% difference between its peak and low prices. Although 2018's intra-year decline of 20% is larger than the last few years, the S&P 500 has still posted positive annual returns in 29 of the last 39 years. While volatility may continue, other critical data suggest the economy will remain strong. For example, the GDP will likely hover between 2 and 3%, and unemployment should remain low. We expect 2019 to bring continued growth in the economy, but volatility and headlines can unsettle even the most seasoned investors. So, if you feel concerned or want to understand what's happening, lean on us for support. We're here for you, and we want to help you make the most of your financial life. What can you do in 2019 to move toward your family's goals? Here are some action items for you. If your life or personal situation changes, please keep us in the loop. We want to hear about important family events. We also care about health issues, employment changes, any financial developments that may change in your situation. And if you find yourself thinking about new goals or reevaluating your priorities, please share your thoughts with us so we can help you pursue the life you most desire. On top of specific adjustments to your financial life, we also want to know if you feel differently about investments. This could be details like a shift to your feelings about risk or any concerns about the market environment. Finally, remember to go over your estate documents, beneficiary designations, and other paperwork to make sure it's all up to date. A well-organized estate is one of the best gifts you can give to your family. We're here to talk through whatever financial questions, worries, or excitement you may have. Our priority is to always help you make informed choices and stay on track. Throughout 2019, we're going to focus on delivering the following action steps to you. We promise to keep you informed through regular communication and be here when you have questions. We will manage your investments based on your personalized strategy, and every recommendation we have will be in your best interest as we are fiduciaries for you. We will also stay on top of changes in the market environment and make prudent adjustments where necessary that are in line with your plan. Thanks so much for your time today. As you can tell, I'm passionate about helping you understand the markets and find facts amidst the hype. We hope you enjoyed the details we shared today. Please remember that nothing we shared here is a recommendation. Feel free to contact us at 541-330-0220 if you have any questions or want to talk about your personal situation. Once again, this is Chad Stayskull, President of Eagle Wealth Management, signing off for our 2019 State of the Markets.